What if I told you there's a loan program that lets you buy a home with zero down payment, even if your credit isn't perfect? Sounds good to be true, right? But it's real. We're diving into the USDA loan program, a hidden gem for home buyers in rural areas. But watch out. There's one mistake that could easily disqualify you instantly. In this video, we're breaking down the USDA loan process step by step, covering the 2025 loan requirements you need to know. And we're going even further, comparing USDA versus FHA loans so you can decide which one makes the most sense for you. So let's start with the basics. What exactly is a USDA loan and why is it one of the most affordable options for buying a home in rural areas? The USDA loan is a mortgage backed by the United States Department of Agriculture, designed specifically for home buyers in rural communities. But here's where it gets interesting. There are actually two types of USDA loans. First, there's the USDA Direct Loan Program, built for low-income households. Now, this one comes with more restrictions, but here's the kicker. Monthly payments can actually be subsidized. That means the government helps to cover part of your mortgage payment. But there's a catch. The loan must be obtained directly from the USDA. It's not something most lenders offer, and it's not the loan we're focusing on today. The second, far more popular option is the USDA Guaranteed Loan Program, perfect for moderate income homebuyers. Unlike the direct loan, this one is backed by lenders, so you don't have to deal with the USDA directly. Instead, you can directly go to your lender and get a USDA loan without the extra hassle. Here's why you're really here: the requirements and benefits of this loan. And this is where things get really interesting. The USDA loan requires zero down payment, so you can buy a home without paying a single dollar down. But before you get too excited, there are a few more things that you need to know. One of the biggest questions people have is, what credit score do I need? Well, here's the truth. USDA doesn't technically have a minimum credit score. Some sources say you can qualify with as little as 580, but most lenders want to see at least a 640 to make the process smoother. If your credit score is 640 or higher, you can take advantage of automated underwriting, making approval much easier. But if your score is below 640, you'll have to go through a manual underwrite, which means extra steps, additional documentation, and a higher chance of needing extra savings or compensating factors to get approved. And here's something they don't always tell you. Just because USDA allows lower credit scores doesn't mean all lenders will approve them. Many lenders have what's called overlays, meaning they set their own stricter rules. So even if USDA technically allows lower scores, some lenders might flat out refuse to approve a loan under 640. Now here's another huge advantage of USDA loans. You get lower interest rates. So as of right now, a 30-year fixed rate conventional mortgage sits at around 7.25%. But USDA, somewhere between 6.5 to 6.7. That's 0.5% lower, which can save you thousands over time. Now, let's talk about the real deal breaker for most people trying to qualify, which is income limits. This is where most home buyers get tripped up. USDA loans are meant for low to moderate income households. So if you make too much money, you could be disqualified. But how much is too much? Well, it depends on where you live. Your total household income, including everyone over 18 in the home, can exceed 115% of the area median income. For example, let's say you're looking to buy a home in Lonoke County, Arkansas, which is a rural area where USDA loans are commonly used. And let's say the income cap for a family of four is $122,450. Now, here's where things get tricky. Let's say you're a couple with two 18-year-old kids who also work, and each person earns $50,000 per year. That's $200,000 combined household income, which is way over the limit. But if it's just a couple living in the home, each making $50,000, that's only $100,000 total. So you're good. And here's another thing. Income limits vary by location. Two counties right next to each other might have completely different income caps. So it's important to check your area's limits before applying. Now, not all homes qualify for a USDA loan. Let's talk about location requirements. USDA loans are strictly for rural areas. But here's the thing, what's considered rural might surprise you. In densely populated places like Los Angeles, Miami, or Chicago, USDA loans are off the table. But if you head about 30 to 40 minutes outside of a major city, then you're suddenly in USDA territory. So here's what to do. There's a link in the description where you can check any property address to see if it qualifies for a USDA loan. So don't assume, make sure you check first. Another big rule, the property must be in your primary residence. No investment properties are allowed. But here's the loophole. You can rent it out after living there for at least 1 year. And you don't have to be a first-time home buyer. Even if you owned a home before, you can still use a USDA loan as long as you don't have a bunch of money sitting in your bank account that could be used for a down payment. USDA loans are designed for people who genuinely need them. Now, one last thing, if the property is generating income, you're out of luck. That means if you're looking at a home that comes with a working farm that makes money, USDA won't allow it. But if you're running a small business from home, that's totally fine. USDA loans are strictly for financing residential properties, not farmland, not vacant land, and definitely not for building a home from scratch. This program is designed for primary residences only, meaning you can't use the land to run a business or generate income. One important thing to know about USDA loans is that there's no maximum loan limit. Sounds great, right? But here's the catch. Your debt to income ratio, or DTI, will ultimately determine how much you can borrow. Just because there's no official cap doesn't mean you can't get an unlimited loan. Your income, debts, and ability to repay will set the limit. Now, before we dive deeper into USDA, let's compare it to FHA loans. Because if you're considering USDA, there's a good chance FHA is also on your radar. FHA loans are far more flexible when it comes to location and income limits. Unlike USDA, FHA loans have no income limits. You can make as much money as you want and still qualify. They can also be used anywhere. There are no restrictions on locations like there are with USDA. So if your income is too high for USDA or the home you want isn't in a rural area, FHA might be your best bet. So let me tell you the biggest differences between USDA and FHA loans. First is the down payment. USDA loans require 0 down payment, while an FHA loan demands at least 3.5% down. Then there's income and location limits. USDA loans come with strict income caps and rural location requirements, and FHA doesn't. FHA loans charge a 1.75% upfront mortgage insurance premium, whereas USDA only requires a 1% guarantee fee, saving you thousands right off the bat. And then mortgage insurance. USDA loans have a cheaper monthly mortgage insurance than FHA, but USDA's insurances last for the entire long term, unlike FHA's, which can eventually be removed. So side by side, USDA can save you about 4.25% in upfront costs compared to FHA. A huge difference, but FHA gives more borrowing power and is the go-to option if you don't meet USDA's income or location rules. And let's talk about mortgage insurance. Mortgage insurance are two words that make home buyers cringe. But if you're putting less than 20% down, it's part of the deal. Conventional loans require private mortgage insurance when you put less than 20% down, but it disappears once you build up enough equity. But USDA and FHA loans, they always require mortgage insurance. And here's where things get interesting. USDA calls it a guarantee fee, but let's be real, it's just mortgage insurance. So why does this exist? And it's simple. You're putting less money down and are considered a bigger risk. Lenders need a safety net in case borrowers default, and that's where mortgage insurance comes in. For USDA, mortgage insurance comes in two forms. An upfront guarantee fee, just 1% of the loan amount rolled into your mortgage, and a monthly mortgage insurance, 0.35% annually, divided into monthly payments, which is much lower than FHA. So let's break it down with an example. Say you're buying a $200,000 home with a USDA loan. Your loan balance gets bumped up by 1%, so instead of financing $200,000, you're actually financing $202,000. Your monthly mortgage insurance is 0.35% of that balance, which comes out to $58.92 per month. The more you borrow, the higher the monthly mortgage insurance. So for a $300,000 home, your monthly mortgage insurance will be around $88 per month. And for a $500,000 home, it will be about $147 a month. Here's the catch though. USDA mortgage insurance never goes away. Unlike conventional loans where PMI can be removed once you hit 20% equity, USDA's mortgage insurance sticks around for the life of the loan. However, it gradually decreases as you pay off the balance. Now, FHA is no different. FHA loans also require upfront and monthly mortgage insurance, but their upfront fee is higher at 1.75%, and the monthly insurance costs more as well. That's why many home buyers eventually refinance out of USDA or FHA loans once they build up enough equity to ditch the mortgage insurance altogether. Now, finally, let's talk about debt to income ratio, because this is the number that really determines how much home you can afford. And trust me, this is where a lot of people get caught off guard. Now, before we dive into USDA's DTI requirements, let's first break down what DTI actually means. This is a huge factor when it comes to getting approved for a USDA loan. You mess this up and you could really be denied instantly. So what exactly is DTI? It's your total monthly debt payments divided by your gross monthly income. Let's break it down step by step. So step 1, lenders calculate your income before taxes, also known as your gross income. They don't care about what's left after taxes, 401k contributions, or other deductions. So let's say we have 2 borrowers, each making $50,000 a year, for a combined household income of $100,000. We take $100,000 and divide it by 12 months, which gives us $8,333 a month in gross income. Now that we've got the income number, let's calculate your DTI. There are 2 types of DTI lenders to look at. Front-end ratio. This is just your housing expenses, including principal, interest, taxes, homeowners insurance, and mortgage insurance. And then back-end ratio. This includes everything from your front-end ratio plus any other monthly debt payments that appear on your credit report, such as car loans, credit card minimum payments, student loans, personal loans, or installment plans. So now we're going to run some numbers. Let's say the total monthly housing payment for your new home, including everything, loan, taxes, insurance, mortgage insurance, etc., is about $2,500. Take that $2,500 housing payment and divide it by $8,333 gross income. That's 30% front-end DTI. Now let's add in some extra monthly debts. Car payment, $500, credit card payments, $250, student loans, $100, and other monthly debt, $150. That's a total monthly non-housing debt of $1,000. So let's calculate your back-end DTI. You take that $2,500, which is your housing cost, plus the $1,000 of other debts equals $3,500. Now divide $3,500 by $8,333 gross income. That's 42% back-end DTI. Now here's where things get tricky. If you Google it, you'll likely see 41% listed as the max DTI for USDA. But in reality, it's not that simple. Lenders can go higher, sometimes up to 45%. But to qualify at the higher end, you'll need a strong credit score, extra savings in the bank, and a solid history of on-time payments. Most lenders want your front-end DTI under 34% and back-end DTI under 45%. But exceptions can be made if you have strong compensating factors. And here's a pro tip. If your DTI is pushing the limit, start talking to a lender ASAP. The sooner you know where you stand, the better chance you have of fixing any issues before applying. Now, let's talk about closing costs, which is a hidden expense that no one ever talks about. A 0 down payment loan doesn't mean you're buying a home for free. You still have to pay closing costs. A lot of people assume no down payment equals no out-of-pocket costs, but that's definitely not true. Now, how much are closing costs? They can typically range between 2% to 3% of the purchase price. So if you're buying a $300,000 home, you should be prepared for $6,000 to $9,000 in closing costs. But here's the good news. There are ways to reduce or even eliminate the closing costs. First, there are seller credits. You can ask the seller to cover part or all of your closing costs in your offer. USDA allows up to 6% in seller concessions. Then there's lender credits. Some lenders offer closing cost assistance by rolling the fees into the loan in exchange for a slightly higher interest rate. And number 3 is rolling costs into the loan. If the home appraises for more than the purchase price, USDA lets you finance closing costs into the loan. So for example, you're buying a $300,000 home, but it appraises at $305,000. With the extra $5,000 in value, that can be used to cover closing costs, meaning you could buy the home with almost no money out of pocket. But keep in mind, not every home will appraise above the purchase price, and not every seller will agree to pay the closing costs. So always be prepared to pay at least some fees. And here's a pro tip. Even if you don't end up needing the money, have at least 2% of the purchase price saved just in case. Now, here's the final requirement. If you made it this far, you checked off every box, there's one last hurdle before getting that USDA approval. This is your job history and income stability. Most lenders want to see at least 2 years of steady employment and consistent income in the same industry. But that doesn't mean you have to be at the same job for 2 years. If you switch jobs but stayed in the same field, you're usually fine. Now, this can disqualify you. Job hopping across different industries, for example, going from a sales job to working in a restaurant, or long gaps in employment without a valid reason, such as a school or medical leave. Also, there's unstable income from inconsistent contract work. And here's where most people get caught. Your job and income must meet USDA's guidelines before you go into contract. So if you're unsure where you stand, talk to your lender early. So at the beginning of this video, I mentioned one critical mistake that could immediately disqualify you from a USDA loan. And here it is: not meeting USDA's income and employment requirements before you apply. Too many people go house hunting without getting pre-approved first, only to realize their income, job history, or DTI doesn't match USDA standards. Now, here's your last pro tip. If you're serious about buying, talk to a lender now. If you're 6 months away from buying, getting guidance early could save you from the heartbreak later. Before diving in, make sure both are solid. The easiest way: work with a professional. My team and I, we help a lot of people through YouTube, and we love to help you too. Just use the link in the description to get in touch. So if this video was helpful, hit the like button, subscribe, and share it with anyone thinking about buying a home. And if you're already ready to move forward, check the links below.